Good morning and welcome to today's webcast, Year-End Tax Update for Financial Institutions. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
I'm pleased to introduce today's presenters from Moss Adams, Kristine Hoeflin, Partner, and Amy Jessup, Senior Manager. And Kristine, I'll turn it over to you to get us started.
Great, thanks, Emily. So by way of introduction, I'm Kristine Hoeflin, Tax Partner with Moss Adams. I've had the privilege of being with the firm for about 15 years now, focusing in the financial services space, and work throughout our firm's footprint from Alaska to Texas with about 50 banks throughout the year. We do a number of planning and strategy for our clients and a number of the ideas and best practices that come out of discussions are brainstormed with my colleague Amy Jessup, who I'm glad could also join me this morning for the webinar.
Thank you. So Amy Jessup, I've been with Moss Adams for 21 years, and I've worked almost exclusively with financial institutions that whole time. I am involved with consulting on all sorts of issues, from stock compensation planning to mergers and acquisitions accounting, and this time of year especially deferred tax assets and information reporting.
So in terms of what you have to look forward to today, federal tax reform will be touching on key provisions, financial statement impact in 2018. We'll be taking some time for a state tax update, and then there's a handful of other items that we think would be helpful to keep in mind as you come to the end of the year, so we'll wrap up the hour with those items. All right, kicking off tax reform. So certainly going into tax reform, we heard a lot about tax law being simplified. It was too complicated. We needed to make it less complex. How'd we do? So on the individual side, perhaps we saw some simplification, but as we look to business taxes, certainly see a whole new mountain of regulatory guidance out there to climb. Certainly there was not a lot of simplification that we're seeing on the business side, and so here we are undertaking a whole lot more mountainous efforts. As we talk about what that looks like, we'll be taking a look first at the items that impact the tax rate, moving towards temporary differences, and also talking about some of the impacts for flow-through companies as well. So from a banking industry standpoint, just an overview of tax reform for an understanding of how we ended up where we did. Certainly going into the political process of changing the tax rates, the items that were front and center were largely focused on reducing the corporate tax rate and reforming international tax law. So those were the items that Congress was certainly tuned in on making sure that that happened. What you see going along with that is that in order to keep Main Street happy, you see a whole host of other provisions that were tossed into the tax reform packages to keep small businesses appeased, to keep individuals appeased. And then in addition to that, what you also saw occur was that because of certain Senate budgetary items that needed to be kept to, you could increase the deficit by, say, up to $1.5 trillion and still have the law passed with a majority vote. And so what essentially occurred is that a whole bunch of other provisions were tossed in towards the end to make sure that the budget would balance as they saw fit in terms of increasing the deficit. And some of the beneficial provisions that went through ultimately ended up needing to be sunsetted in order to meet those parameters. And so you'll see as we go through some of these slides that some of the provisions do expire at the end of 2025. The corporate tax rate, which was what was essential, as well as international provisions, which were essential, those are said to be permanent under these rules. The others, a number of them, you do see sunset. To the rescue is the concept of Tax Reform 2.0. It's out there as a law working its way through Congress to make some of these provisions that are set to sunset actually become permanent. There's a number of political challenges around actually getting Tax Reform 2.0 through. So certainly we'll keep you posted as we see that progress. But for now, it's probably not holding our breath to see that push through, but we are keeping tabs on how it's progressing. So it's no surprise to anyone on this call that the tax rate's been lowered from 35% to 21%, and we all saw that run through the corporate tax provisions as we rounded out the 2017 tax year end. What we do have occurring, however, is that as we look at the 2018 financial statements, a number of the planning items that would have been pushed through 2017 tax returns have been included now since you prepared those 2017 financial statements. And so what that ultimately means is that as we look to tax rate reconciliations and truing up all of your deferreds coming into this year, that it's likely that, as you saw in 2017, perhaps a large write-down of deferred tax assets as we come into 2018 and see some of the planning items rolling through, that will likely have another line item for the impact of the tax rate change. And for a number of the folks that we work with, we would anticipate seeing that being a favorable impact of tax reform due to the planning that was ultimately implemented on those returns. As a best practice to be mindful of, if you haven't already done your true-up entries or thought about how the completion of the tax return will impact your rate reconciliation coming into the new year, now is a great time this month of December to be running those entries through, doing the return to the provision calculation so that you can capture and be set to incorporate any of those changes that were on the 2017 return that dealt with timing differences. Another item that has the ability to impact your tax rate, and we see this with some of our larger public corporations, is a provision 162M. This is specific to public companies, so for those of you who are public or aspire to be public at some point in time, this is looking at compensation that would be in excess of $1 million for your covered employees. So any of your CEOs, CFOs, or the highest 3 compensated officers that are reported under SEC rules, this is the group that we're looking at. What is new as it pertains to tax reform is that once a covered employee, always a covered employee. So as we look at that group, if an individual retires, and they were once a CEO, they are always going to be subject to that $1 million limitation. So what that means is that where we see some companies get caught is perhaps that CEO had planned to take a lump sum benefit in retirement upon putting their notice in, and that lump sum payment would be in excess of $1 million. What that means to those companies today is that they need to be planning ahead for the potential that some of those contributions that they're making or some of those accruals that they're setting aside may not ultimately be deductible to the company in the future if they're known to be in excess of that $1 million threshold. So this is where best practice involves taking a look at your deferred tax balances as it is associated with certain deferred comp plans, and really just making sure that you don't have any that would be in excess of that $1 million upon retirement. What it also means is that the performance-based compensation rules that were previously included under 162M are now no longer. There are some grandfathering rules that would come into play, but in general, a new compensation plan would be unable to build in performance-based components. And so it becomes that much more important as well to be looking at what it might mean to maintain certain arrangements as grandfathered status, and that's looking at plans that would have been in place through 2017. Another permanent difference item that changed through tax reform relates to BOLI, and this is specific for acquiring companies that have essentially, for example, done a merger or an acquisition of another institution that has BOLI. In the past, you all with BOLI are familiar that that's generally treated as a tax-exempt item that's favorable in your tax rate. As a result of tax reform, there's provisions that essentially indicate that the future appreciation of those BOLI policies, the future increases in cash surrender value, lose their tax-exempt status if there's not a substantial family business or financial relationship with the insured. So if, for example, you acquire another bank, their CEO and CFO have BOLI policies on them, but they don't come over as employees for a period of time, then those BOLI policies, increases in cash surrender value that are on those types of folks, is now not a book tax difference. It's not tax exempt. So you'll generally want to bifurcate those items in your tax provision. There is some grayness to the rules around this particular item, and so if this does pertain to you, always happy to continue this conversation. FDIC premiums. For those of you that work with banks that are in excess of $10 billion or aspire to be of that size, just a quick note here that the FDIC premiums do phase out over $10 billion, and that is a new phase out as a result of tax reform. So perhaps not exciting, but certainly detail-oriented. There were a number of changes around fringe benefits, entertainment expenses, et cetera, as it relates to tax reform. This is an area that we've been getting a number of questions because the original guidance out did leave a good number of items for interpretation. From a big picture standpoint for meals and entertainment, your entertainment expenses are no longer deductible. So it would be ideal to have a GL set up for entertainment that's earmarked for being non-deductible. Separate from that, your food expenses, so your meals expenses, whether it's internal or external to the company, those are going to be 50% deductible. There used to be a few buckets for meals. Now they're just all 50% deductible. And then for the items that would be your company Christmas party and some of those things that in the past were truly 100% deductible, those are still there. So as a result of some of these rules, we do have a new Moss Adams guide out. For those of you that have questions or are looking for best practices, we've just recently in the last week or so put out a guide. So if that's something of interest to you, please feel free to reach out to us for that if we haven't already gotten that into your hands. A few other items to be mindful of: the transportation fringe benefits, that has changed under tax reform, as well as bicycle commuting reimbursements to the few that may apply to. And then there were some more narrowing of the rules around employee achievement awards to be mindful of there as well, as you can see on the slides. Accrual method income. So as a result of tax reform, the rules associated with accrual method income provide that income for tax purposes can be recognized no later than when it is recognized for financial statement purposes. And so this is looking at, for example, matching up your taxable revenue sourced items with your financial statements. There's exceptions as it relates to fair values, and there's also exceptions around, say, items that would generate capital gains or losses. But in general, you would be wanting to review your deferred tax liabilities to see if any of those are associated with revenue items. Some common ones as it relates to banks. First off, the mortgage servicing contracts. There was actually a specific carve-out for this as a result of the great lobbying efforts from the American Bankers Association and Mortgage Bankers Association. So if you do have a deferred tax liability or you're deferring recognition of income on your MSRs, that is still okay. Where there's perhaps some grayness is if you have servicing assets related to items that are not secured by real estate, those may need to be picked up into your revenue, matching book and tax. So there would generally be a method change associated with those items if you're not currently matching your book and tax timing of recognition. Another item that comes into play with banks is associated with original issue discount. Some of you have deferred loan fees that are being accelerated even beyond what's being done for GAAP purposes. Those are items that will not be required to be changed in 2018. They provided one additional year of deferral for those items until 2019. And so for a handful of you, you may need to be looking at method changes to, again, match your book and tax timing on the recognition of income. The business interest deduction, so this particular item results in a limitation on net business interest expense. So right off the bat, when the articles were going out that this might be coming out, there were a number of questions from my banking clients of, are they really going to limit our interest expense? And the good news is that this is net interest expense, so to the extent that we have net interest income, we're looking to be golden there. Where we're putting this slide up and wanting to make sure that this group is educated is because it's very likely that if you have clients with average gross receipts over 25 million and they incur a fair amount of interest, that their tax advisors are planning with them. What you'll see occur is that if the taxable net interest expense exceeds 30% of their more or less EBIT, then they would be subject to certain limitations. So it's possible they may look at the way that they're planning around their debt versus equity or items that create interest expense versus maybe lease expense. They might be looking at some strategies to help so that they're not subject to these limitations. They do carry forward. The interest expense that is limited does carry forward, so they would ultimately get it at a certain point in time. But big picture, this was a key revenue raiser in the overall scheme of tax reform, so it isn't expected to impact a number of taxpayers. That brings us to one of our polling questions.
All right, our first polling question for today. Has your institution seen a change in customer borrowing activity as a result of the new interest limitation rules? And your options are yes, no, or I don't know. And I'll give everyone a few moments to respond. To participate in our polls, please click the button next to the answer you choose and hit submit. And I'll give everyone a few more seconds here. And let's go ahead and take a look at the results. Back to you.
Okay, great. Well, I'm happy to hear that it hasn't had a large, looks like a large impact, and maybe that's because of the gross receipts. Let's look at the next changes as they apply to business related to tax reform. So net operating losses under the old rules, they could be carried back 2 years and carried forward 20 years. And now, under the new law, there's no carryback at all, except for those NOLs that were generated prior to tax reform. And the carry forward is now indefinite, which is great, but the deduction is limited to 80% of taxable income. So this was also a revenue raiser. Where it is particularly beneficial is in a meals and entertainment in a merger and acquisition context where an NOL is being acquired by a target entity, and even though the Section 382 limitations still apply on an annual basis, because those carry forwards are now, if they're generated after tax reform, they're indefinite, there might not be a haircut on the overall impact. So that is one bright side. The next topic, alternative minimum tax, has been repealed starting in 2018. So that is one area that has been simplified. So if you had tax credits, if you had AMT tax credits, those are going to now be refundable. And it's refundable in phases. So 50% of the tax credits for AMT are going to be refundable through 2020, and then the rest will be refundable in 2021. So if you haven't already done so, there will need to be a reclassification of the AMT tax credit of 50% of that from a DTA to your income tax receivable. Also, a very beneficial result from tax reform is the increased depreciation options. So we've seen that bonus depreciation has increased to 100% full expensing for the next few years. And then after 2023, then there's a phase down that starts where the percentage is less than 100%. With Section 179, the expensing limits are now larger. They're $1 million. So where there is kind of a drafting error in this topic relates to qualified improvement property. And in the past, qualified improvement property was 15-year property. It would be subject to bonus depreciation. But due to a drafting error, it is not currently eligible for bonus depreciation. So we're waiting for that to be fixed in future guidance. But unless that happens, what I have been advising the clients I work with is to take Section 179 on those assets, assuming they qualify, assuming they're not a structural component of a building. Take 179 on those assets and then take bonus depreciation on the remaining assets. So for pass-through entities, so this would be S corporations and partnerships, If your institution is an S corporation, or if you have shareholders that invest in partnerships or S corporations, or you have clients that are these types of entities, there has been a significant change related to how pass-through income is taxed, because now there's an allowed 20% deduction of qualified business income. And so this is the area that sunsets in 2026 unless Tax Reform 2.0 makes it permanent. So I'm going to walk you through some of the elements of this. It's actually quite complicated, but I'll see if I can simplify it. So in general, if an entity passes through pass-through income, and it is of the type of income that is qualified business income, then on the shareholder's return, they can take a 20% deduction against that income. So proposed regulations came out earlier this year that clarified that the 20% deduction would apply to companies engaged in the business of taking deposits or making loans. So therefore, they have clarified that this 20% deduction would apply to banking activity that is passed through to a shareholder on a Schedule K-1 from a bank. So this is core banking activity. And as a result, this has allowed for some benefits to be realized by these shareholders as a result of tax reform. So that's one exciting element. But there are other additional considerations that need to be analyzed. So what if a financial institution performs services, and the IRS calls it specified service, trade, or business, that is outside the scope of the core banking activities of taking deposits and making loans? So they have set a safe harbor that says that if you have gross receipts under $25 million and you provide services that are under 10% of what is not considered to be core banking activities, then all of the income is still eligible to receive the 20% pass-through deduction. And for larger businesses of having gross receipts in excess of $25 million, the safe harbor amount is less than 5% of gross receipts. So what we don't know is if this safe harbor may act as a cliff. If you exceed those de minimis amounts, does that taint all of the bank's activities? And so there's a thought that if the separate activity is its own trade or business, then that could be carved out, and that piece of it would not be subject to eligible for the 20% deduction, whereas the core banking activity would be allowable to be eligible for the 20% pass-through deduction. So some examples of what would be considered this SSTB income are tax-exempt income, because that would be related to investment and investment management, which is outside of the scope of the core banking activities. There would be trust operations. It would be mortgage sales, because that would be considered trading or dealing in securities. And then also services such as wealth management and retirement planning and brokerage services. So this is definitely, even though it's a great benefit, it's definitely something that needs to go through a further analysis. And that brings us to our next polling question, which Emily will walk you through.
Great, thank you. Our second polling question: has your institution considered changing its entity structure due to changes resulting from tax reform? And your options are yes, no, or I don't know. As a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. We're on our second question here. I'll give everyone a few more seconds. And let's take a look at the results. Back to you.
Great. So no is not a surprising answer from the standpoint that many of the banks throughout our footprint are structured as C corporations, and there were reasons that went into that decision making. And with the new 21% tax rate, it's even that much more advantageous to be a C corporation. With our S corporations, we've generally heard the questions asked: does it still make sense to stay an S corporation? At what point does it make sense to consider switching to C? So those discussions have definitely occurred throughout the year where we see changes. Typically, it's been a fairly small group that would be actually considering changing its entity structure as a result of tax reform, but the discussions are always healthy. Taking a look at just a few of the select individual provisions here, we did want to touch on the highlights coming through from an individual standpoint. In general, it did lower the tax rate for most taxpayers in terms of rate bracket levels. A number of deductions and credits were eliminated or limited with expansion of some others. I think for those of you in California, you're very well aware of the limitations on the state and local income tax, or the state and local tax deductions, and certainly that's had some adverse impact there. And then, as discussed earlier, many of the changes from an individual standpoint will cease to apply after 2025 and will revert back to the previous law. So that is currently set to sunset. And then we'll see if we end up with this becoming permanent as a result of Tax Reform 2.0. Just taking a look quickly at the brackets here, this is married filing joint, looks very similar to single. What you can see is if we take, for example, a look at the 100,000 bracket, someone making 100,000 would be in the 24% bracket now, as opposed to 28% top bracket. So certainly a nice percentage point savings there. Likewise, as we get to 300,000, interestingly, you see in this bucket that maybe there would be some increases, but that's fairly rare in terms of the stretch. Once you get to the later income thresholds, the top bracket is now the 37% rate. Other notable items impacting individuals: the mortgage interest deduction, as some of you may have become aware, and as many of you do mortgage lending, there is a new limitation for home equity indebtedness that reduces that limitation to $750,000. So previously that would have been $1 million. Now the interest is deductible on indebtedness under $750,000. And there are some limitations in terms of making the indebtedness acquisition indebtedness. So no longer are the days of taking your home equity line of credit, purchasing an auto, and then deducting that interest expense. Now under the new rules, in order for the interest to be deductible, those would need to be applied to actually the improvements of your residence in order for the interest to be deductible. There are some grandfathering rules that kick in as it relates to the mortgage interest deduction, so that information is available as well. From a W-4 standpoint, as we look at making sure that folks are withholding appropriate amounts, the IRS is looking to shift some of the burden of that responsibility more heavily on employers than in the past. While the slide here says 2019, they did go ahead and postpone that to 2020 in terms of putting out a new form W-4, and they may actually require annual updates to this form to help with essentially improving their ability to collect on taxes owed from individuals via withholding. So stay tuned on that. I'm sure we'll be talking about that in a year from now.
All right, we have our third polling question. Does your institution have an understanding of the state tax exposure to states that it does not currently file tax returns in? Again, we have yes, no, or I don't know. And for those of you that would like a copy of today's slide deck, you can download them now from the folder that says Slide Deck and Handouts to the right of the slide view. We will also be sending the slides via email after the webcast. I'll give everyone a few more seconds. And let's take a look at the results. Back to you.
All right, well, that is great news. It looks like there are a lot of people on the call that do have an understanding, and that's great. For those that answered no or I don't know, I'm going to walk you through some additional considerations. So what we're seeing on the state tax side is that with federal tax reform and other changes, states are becoming more aggressive, and they have over the past few years, but we have seen momentum with that trend, and it is continuing, and we have found that tax returns are being filed by more entities in recent years than maybe in the past. And so one thing to keep in mind is that for a financial institution, you may have created Nexus in another state beyond where you have branches, is if you have loans secured by property located in that state, if you provide services to customers located in that state, and if you have employees that work in that state. And one thing that happened recently is the Wayfair case, and you may have heard that Wells Fargo has very publicly announced that they have provided additional reserve against what they consider to be their Wayfair potential liability. So what Wayfair said is that for sales and use taxes, they have enacted economic nexus, which have required sellers meeting certain criteria, in this case, $100,000 of sales or 200 transactions in that state, to collect and remit sales tax without the seller being physically present in the state. So where this has an impact beyond sales and use taxes is that states may start applying this same rationale to income taxes. So here we see the highlighted states jumped on that Wayfair decision bandwagon, and so now they are switching to an economic nexus applicability with regard to the sales and use taxes. So, like I said previously, we have seen a trend of changes in the states, and it exploded in this past year, and we are going to continue to see more states change. So, for instance, in Washington, they announced that they are going to require certain remote sellers to begin collecting Washington retail sales tax. So they are making a change. Oregon recently announced, effective as of 2018, that they are moving to a market-based sourcing. And so with regard to apportionment, most apportionment has specific rules as it applies to each state. And so as each state are changing, so are the apportionment rules. So this also provides a certain amount of opportunity So for those that do have an understanding of what their exposure is, that's great. If you are not one of those, you may go back and look through and see where you have customers in other states that services are being provided to, or loans in those states that are secured by real property, and at least quantify what the income is related to those amounts, and then, multiply it by a general state tax rate to see what the estimated exposure is to that state, and then keep in mind that the statute of limitations doesn't necessarily close if you haven't filed, so you're probably looking for at least 7 years back. And so quantify that amount so you have an understanding of what that amount is, and then you can make a decision as to whether you're going to file in those states in the future. And off of the topic of state taxes, here are some other things that we want to let you know about. One of them is a new deferral election for stock-based compensation. This is pretty cool. So it applies to the stock options or restricted stock units, and unfortunately it's not available to publicly traded companies. It's only applicable to private companies, and it actually doesn't apply to the 1% owner, the CEO, the CFO, or the top 4 compensated officers. So who this applies to is employees that are not highly compensated. And so what they can do is they have the availability to defer taxes on the exercise of an option or the settlement of a restricted stock unit for up to 5 years. And at that time, they do have to pay the tax, but these compensation benefits are non-cash to them. So paying tax on a non-cash benefit may be otherwise a hardship, and so the availability to defer that tax is quite a benefit, and hopefully we'll see that people are taking advantage of this new opportunity. Another item is the Opportunity Zone program, and this is something that I don't know if a lot of banks will get into this, but maybe customers. So this is an opportunity to defer gains, similar to a like-kind exchange, although different in a lot of ways. If you have a capital gain from any sort of source, you can defer that gain if you invest it in a qualified opportunity zone. Property, which are all over the place, and the deferral of the initial gain is taxable at a certain point, but then after that point, there's a permanent step-up in basis. So there is a lot of details involved with that, but it's a great program that you should be aware of, and maybe we have on our website, we have several links to additional information about this program. One thing that came about with tax reform is the paid family and medical leave tax credit. So this is only around for 2 years, but for companies that are already engaged in this activity, then they can benefit from a tax credit related to the benefits that they're already providing to employees. So that's kind of a bonus. And kind of related to that is the Work Opportunity Tax Credit. So this is a tax credit that if you have certain employees that fall into a target group, then a tax credit can be taken related to those employees. And I know Moss Adams has a program where we have automated the process and we poll employees, and it's done very, because it's automated, we've had better success with this than when companies have done it internally in order to maximize those credit opportunities. On a different subject, ASU 2018-02 talks about the reclassification of certain items. So because of tax reform for C corporations, when there was a revaluation of the deferred tax asset related to the available for sale gain, that was the impact of that went through tax expense, current tax expense, and as a result, the OCI balance had this stranded tax effect amount, and ASU 2018-2 says, okay, well, if you don't, well, because that is awkward, you can reclassify that stranded tax effect amount into retained earnings. And so we just want to remind you that if you haven't already done that, then go ahead and make sure that gets done before you close the end of the year. And that brings us to our next polling question.
All right, our final polling question. Overall, do you consider the impact from tax returns tax reform has had positive effects to your institution? And your options are yes, no, or I don't know. And once you have completed all CPE requirements, you will be able to download a PDF of your CPE certificate from the certification widget to the right of the slide view. A couple more seconds here. And let's see what everybody has to say. Back to you.
And no surprise here, C corporations and S corporations received a considerable rate benefit coming through this year. So I would expect that it's been positive for many of your institutions. The great news here is that it means more capital is retained for your institutions to be growing. And then to the extent that you have more than you need, we've seen a lot more dividends this year as well as a result of tax reform. All right, so Section 475A, this is not a section that gets a lot of attention, but it has been around for a fair amount of time, and it's good to revisit from time to time. So mark-to-market accounting for dealers and securities. What's a dealers and security? Do you fit into this? The general rule is that if you are regularly originating and selling loans, so if you're selling more than, say, 50 loans a year, for example, you are likely considered a dealer in securities. And so what that means is that best practice is you should have some sort of documentation on file that indicates which of your loans you're intending to hold for investment and which of your loans you're intending to mark to market and ultimately sell. What we see here is a lot of institutions do indeed have documentation that they're using for GAAP purposes that sets forth the intent. That documentation doesn't always at this point specifically reference Section 475, and that's where we do want to make sure that somewhere along the way we get that language in there that does make reference to the tax code to make very clear that if you are doing a designation for GAAP, that it's also preserved for tax purposes. And in certain situations, your GAAP and your tax may not align. So that'll be a best practice. If you haven't talked recently with your tax team about that, we'd be happy to pick up that conversation for those of you that it applies to. Information reporting, so Form 8937, another item that's been around for a handful of years and good to keep top of mind, especially as organizational actions are taken. So this is a form that should be either filed with the IRS and issued to your shareholders or alternatively uploaded to your website anytime that there is an action that impacts the shareholder's basis in shares. So where we most commonly see this apply is if there's stock dividends or stock splits, that information you'd want to report on Form 8937, as well as any merger acquisition information where stock is used as part of the consideration. So if you are acquiring another institution, this would also be an item that gets reported on the acquirer's website so that the shareholders would have information to make reference to as it relates to understanding their basis in the shares. The information that tends to get reported simply talks about what the stock split looks like or what the consideration for a transaction looks like, with the idea being that a shareholder could go back to that form in subsequent periods to make sure they're reporting the appropriate gains on their tax return. Another form to stay mindful of is Form 3921, and this is a form that is for incentive stock option reporting, and it'll be due January 31st following the calendar year end. So if you are a bank with ISOs, just an annual reminder that we should be filing Form 3921 to let those employees know that they've exercised incentive options, as well as the IRS by the end of February or March, that they have, indeed, you have an institution with ISOs. That brings us to the conclusion of our presentation, and I will kick it back to Emily.
All right, thank you. So we do have some time for questions. If you have a question for our presenters, you can enter that into the Q&A box right under the slide. And the first question we have is, what topic do you receive the most questions on from your clients related to tax reform?
And this is Amy. I have to say, hands down, it is meals and entertainment. And, you know, it is, I think it is a result of our clients trying to get those GL accounts to reflect what is 100% entertainment and what is 50% meals. One thing I want to point out is that with the proposed regs that came out, they clarified that business meals associated with entertainment will likely qualify for a 50% deduction if the certain caveats are met, and that is that they're, you know, they would otherwise be deductible. They're not lavish or extravagant, and also that they can be separately identified on an invoice. For instance, if it's a skybox event that's entertainment that includes meals, if the meals can be broken out on the invoice, then more than likely you can take 50% deduction related to those meals. But if it is an event that is invoiced as one total item, then that's where you're going to see that it's going to be categorized as 100% non-deductible, because you can't break out the meal element to that. And Kristine, do you want to also, you know, address that question?
Well, like you, Amy, I do hear quite a bit as it relates to fringe benefits, and certainly meals and entertainment's at the top of that list. But also an odd one that comes up under the umbrella of fringe benefits and the additional tracking that our clients need to do is that the fringe benefits now newly limits the deductibility of parking benefits associated with parking value provided to employees. So it's one that is an interesting, probably record-keeping or tracking item related to tax reform, certainly for our banks that have, as part of their lease agreements, pretty clear information associated with what you're paying for parking stalls that then your employees use. Then it's very easy to then carve out an amount that becomes non-deductible. For some of our clients that maybe it's embedded in an overall lease agreement, or if a building's owned, then it becomes a little bit of an art, if not a science, in terms of coming up with the portion that would be considered non-deductible associated with parking. Very small numbers with our our clients that are in, say, areas that are not significantly urban, but when you get into, say, our San Francisco markets or our LA markets, the numbers get a little bit bigger and have some incremental moving of the needle as far as the tax rate goes.
All right, thank you. It looks like that is all we have for questions. If you think of another question, you can still submit that in the Q&A window, or you can reach out directly to Kristine or Amy via the speaker bio widget. And thank you so much, Kristine and Amy, for a great presentation today. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts icon to the right of the slide view. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy will be emailed within 2 weeks should you have any difficulty downloading it now. Here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us today, and we hope you'll join us again next time.